Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our September monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we'll jump right into it. First of all, an office announcement. We want to wish Henry Kettler a happy third work anniversary. His email is listed there if you want to wish him well on his third anniversary with us. He's been helping us in the service area, but also on the advisor side, and we're looking forward to hopefully a long and meaningful career with him being here with us. You will see him and us, and hopefully many of you at our October quarterly investment forum. We are already at near capacity, so if you plan to attend, please let us know. We hope to see many of you there. So there's a lot to cover. Hopefully you'll find yourself in one of these two booths and not the third one, but a lot to cover, so we'll jump right on in. So first of all, as it relates to markets, markets are broadly up. The S&P is in that 4,500 range, which is up for the year, but still below where we were at peak in January of 22. The rally has broadened, but especially as of end of May, what was driving the market was a very narrow sector of stocks. So you'll see that the top 7 stocks as of end of May drove 97% of the return. That's broadened out, but it's still the top 7 stocks are contributing 2/3 to what the S&P is up so far this year. In fact, if you want to take a look at another way to measure these 5 stocks, the AAA's Apple, Amazon, Alphabet, and then Meta, Microsoft. If you compare that against different countries' GDP, the only 2 countries larger in GDP than the combination of all of these market caps are the US and China. So just dominant performance there on the kind of tech and AI theme thus far this year. So what that means is that the S&P 500 is pretty expensive overall, but there are pockets that are less expensive. So we'll talk about this. So the S&P is trading at 23 times next year's earnings compared to a 10-year average of 21. But other parts of the market aren't as expensive. So if you look at quality dividend payers, 13 compared to a 10-year average of 18. Mid cap, small cap, international EM. So while parts of the market are relatively expensive, there's a lot of value still left in the market. As it relates to the economy continues to fend off recession, at least at this point. So we're growing not by a lot, but the most recent annual reading as of Q2 was just over 2%. Because the consumer drives 70% of the economy, let's look how they're faring. So you'll see savings rate is way down. You'll also see that the excess savings that was accumulated during COVID is getting very close to being burned off. So that's something to keep a watchful eye on as it relates to the consumer. And then this is another thing to look at, which is that the percentage of household income committed to debt reduction or debt service is now up around 10%. That's due to both more debt and higher interest rates on that debt. And you're also seeing delinquencies start to pick up. So the consumer, while remaining relatively strong, is showing some sign of weakness with these measures. The jobs report was good in August. Unemployment rate at 3.8, non-farm payrolls at 187. So a good number overall. This is kind of where the unemployment rate, sits today and compared to kind of where it was in kind of the early pandemic phase. So overall, the 3.8 is a good measure. Inflation, we got this number yesterday just to distinguish between the 2 measures of inflation. Headline is what is mentioned most commonly, but also core, which takes out food and energy, is also a measure. CPI came in at 3.7 annualized for end of August, but a 0.6, which is hotter than expected month over month. So Again, 3.7 is still a lot lower than 9, which is where we were annualized in June of last year, but still well above where the Fed's target is. And if you look at less food and energy, which is core, it's running at about 4.3 compared to CPI at 3.7. So again, these measures are a lot better than they were up here in summer of 22, but still well above the Fed target. And as it relates to the Fed has raised rates over 500 basis points to the highest level in over 22 years. This is just a listing of kind of where we are, with the most recent increase being in July. Expectations are a pause, and then we'll see if the Fed has 1 or 2 rate increases left. This is kind of the probability of where that looks. Again, the expectations are probably another hike in September, and then a pause, and then their predictions are starting to be that summer to late 24, the Fed may actually be lowering rates. And if you look at kind of in different interest rate cycles, raising, pause, or cutting, kind of where stocks or bonds are, we're largely through this period. So we're either in this or this period overall, with likely pause being where we're going to sit for a few months. The average time frame going back to 95 between the last rate hike and the first cut is about 10.5 months. So whether history will repeat itself in this case, I don't know, but we're clearly closer to the end than the beginning as it relates to interest rate increases. There's also a lag effect in the overall economy with interest rate increases. So the fact that the Fed has raised rates over 500 basis points over the last 18 months may take some time for the economy to respond to that. If we look at returns following the last interest rate hike, going back to 94, over the next 12 months, performance is pretty supportive in stocks and bonds. So again, if we get to the point where in September, October, we're at the last interest rate increase, that's pretty supportive of stocks and bonds. We're entering a period which is kind of traditionally weak in September and October, with November and December being higher. So going back to 1926, on average, September is a down month. So seasonally, we're in a weak period. October, November, and December tend to be better. And then as we turn the page 12 months from now, we'll be thinking almost nonstop about the upcoming presidential election. If you look going back to 1926 and presidential election years, this is the average return of the stock market. Non-election is a little bit better, and midterms are worse. And if we look at Q4, which is what we'll be in here in a couple of weeks, prior to an election year, the average stock market performance is about 5%. So that's generally supportive. Again, Q4 prior to an election year. And then just this looks kind of overall at kind of where markets have been going back to 1926, that the average bull market is up 362% in the last just under 7 years. The average bear market down 39, and the average is 1.2. And every bear market is tough to go through. But again, the bull market period, both in the length of time and the momentum, is both higher and lasts longer than the average bear market. You did notice a rebalance recently. We put trade notes out, and in front of that, we rebalance at least quarterly to get back to target and to apply the themes that we think are relevant given market conditions. So just to let you know, that recently happened across the advisory accounts. So all of this is no substitute for contacting us directly for questions about how any of these items apply to you specifically. So we encourage you to reach out, contact us if you have any questions about anything discussed or anything you hear. We're here to serve you. So with that in mind, we'll close. Again, we'll close thanking you for the trust and confidence that you place in us. We hope to see many of you in October at our quarterly investment forum. Until we see you again, be well and take care.